Welcome to The Explainer. Today, we're going to crack open the single most important story a company tells. And believe me, it's a story that can make or break fortunes.
I mean, it's the big question, right? For anyone with skin in the game, investors, employees, even just us as customers, how do you really know if what a company is saying about itself is the truth? See, every single year, public companies have to publish their official story. And we're not talking about some fluffy press release. This thing is jam-packed with numbers, charts, all the details about how they did over the last year.
And it's called the annual report. It's a mandatory document, an official record. The whole point is to give shareholders and, the public a really deep look into the company's health, its operations, and where it thinks it's headed. But here's the kicker. Is that story fact or is it fiction? Okay. Let's really get into it. Because learning to read between the lines of one of these reports, it's kind of like becoming a corporate detective. And today, I'm handing you the magnifying glass. So on paper, the annual report's job is pretty simple. Give everyone a clear, honest picture of the company's financial health. I mean, in theory, it's supposed to be the ultimate tool for transparency.
It's the main tool for accountability, right? It shows exactly how management has been using the company's resources. But and this is where the mystery comes in. While the report is full of hard data, the way that data is presented can be, let's say, creative. There's a ton of room for interpretation, and sometimes that's exactly where the truth gets hidden, right there in plain sight.
All right, so to crack this case, first things first, we need to understand the evidence file. An annual report isn't just one big, boring document. No, it's actually made up of a few very distinct and very crucial parts. The best way to think about it is like a three-act play. Act 1, you've got the director's report. This is management's side of the story, their narrative. Act 2, the financial statements. These are the hard numbers, the balance sheet, the income statement, the cold, hard facts. And finally, Act 3, the auditor's report. This is like the critic's review, an independent opinion on the whole performance. You really need all three to get the full picture. Okay, so now let's meet the main characters in this little drama. You've got the people who write the story, and then you have the independent experts who are supposed to check their work. So on one side, you have the directors. These are the insiders. They're running the company day to day, and it's their job to prepare all these financial statements. But on the other side, you've got the auditors. They're the outsiders hired by the shareholders to be that impartial watchdog. Their only job is to give an expert, unbiased opinion on whether the story the numbers are telling is actually, true and fair.
So, what happens when the storytellers, the directors, want to make things look just a little bit better than they really are? Well, this brings us to the central crime in our whole investigation.
It's a practice called window dressing, and you might also hear it called creative accounting or earnings management. Now here's the thing, it's not always illegal, but it's definitely deceptive. It's all about using the little bits of flexibility in the accounting rules to polish the numbers to make the company look way more attractive than it really is. And this quote really gets to the heart of why they do it. Think about it. A messy, up and down financial performance, that's going to scare investors away. But a nice, smooth, steady upward climb, well, that looks like a perfect picture of health and stability, even if it's not the whole truth.
And yeah, the motivations are huge. Maybe management is trying to pump up the stock price. Or maybe they're trying to get a better loan from the bank. It could be about hitting performance targets to get a bigger bonus. Or sometimes it's as simple as sweeping a few bad decisions under the rug. Okay, so this is the big one. How do you, the detective, spot the clues? How can you tell if the story you're reading is a work of fiction? All right, let's open up your toolkit.
Your first clue, and honestly the most important one, is in the auditor's report. Seriously. Before you even glance at a single number, you need to read the watchdog's verdict. This is where the pros give their official opinion, and it is your first and absolute best line of defense.
So the auditor's opinion basically comes in 4 flavors. What you're hoping for is an unqualified or clean opinion. That's the green light. All good. A qualified opinion, that's a yellow light. It means things are mostly okay, but the auditor found a specific issue you need to look into. But an adverse opinion or a disclaimer of opinion, whoa, those are giant red flags. They're basically screaming at you not to trust the numbers you're seeing.
Okay, so beyond the audit report, you got to put on your detective hat and dig into the details. Watch out for sudden changes in how they do their accounting. Or here's a classic, a huge, unusual spike in sales right at the end of the quarter. But one of the biggest red flags of all, a big gap between the profit they're reporting and the actual cash coming in from operations. Always remember this. Profit is an opinion, but cash is a fact. You can play games with profit, but it's a lot harder to fake cash in the bank.
And if you want to see just how bad this can get, look no further than the Satyam scandal from 2009. This was a textbook case of window dressing on steroids. The chairman literally admitted to inventing over $1 billion in assets that just didn't exist. The fallout was absolutely catastrophic. Shareholders lost billions overnight, and the company's reputation was just gone.
But you know, the detective's job is always evolving. The kind of story that companies are expected to tell now is getting bigger, and it's not just about the money anymore.
So now we're entering the new frontier, ESG reporting. That stands for environmental, social, and governance. See, investors, customers, all of us, we're demanding to know about a company's impact beyond just the profits. We want to know, is this company a good citizen of the planet? How does it treat its people? Is it run ethically?
And this really brings us to a final big question. What's more important? How much money a company makes or the impact it has? Because as our definition of a good company changes, the stories they have to tell are gonna have to change too. The detective work of the future won't just be about spotting financial fiction. It'll be about figuring out a company's true impact on the world.